It's a very good question. Let me tell you, of course, when we started this business, we looked also for international catalogs to help us, how they can help us. But when we looked at them, the end result was not the same as the market. There were big differences. So we said we will take the international catalogs, we'll put them apart. What we will do, because we opened nearly 2 million files per year, after a couple of years, we had a lot of statistics, a lot of information. We found out that insurance companies, what is the number of parts that are related to insurance claims are 230 parts, not 3,000 parts. So first of all, we said, what are the parts that makes the claim? It's 230 parts, which make 98%. Then, for each make and model, we went and we saw 22 makes, they make up 90% of the claims, not 70 makes. So we took these 22 makes. Then we went into these 22 makes, which models are the ones that have the most claims. So we took these models. And then we went, for example, for an Opel, for an Astra 2.0 left door. We saw in the market there were 5,000 prices put for that door. So what we said, what is the average? We did a standard deviation, maximum and the minimum, and we saw $100 was paid, $100. Then what we said, okay, what is the Opel labor price per hour? It's $30, for example. We divided $100 by 30, and we came up with a ratio, for example, 2.5. We fixed the 2.5, the ratio, in the system, and we left the labor price increase or decrease to the insurance company. So when the loss adjuster goes into the system, he will see $100. It is the market price because 5,000 people have given on an average $100. You go to the authorized dealers, the price will be $150, $160. So you turn to the authorized dealers' files, you see that they've also given $100. They are not really applying, they cannot apply because the loss adjuster says the market price $100. This is the way we did it. So we used our own system, own market price, and our own method of calculation. And who helped us in this? The insurance companies. All the technical people, they gave us support for this. But first, you have to get the method right. Then you have to do work. Otherwise, it's a big mess because if you leave it to the car industry, they will tell you today is 2.2, tomorrow they will tell you it's 2.7. And you will tell them what happened from 2.3 to 2.7. Now it's 2.7, this is a new model. And you cannot argue because it's 2.7. But the market says to the service, no, this is 2 point, it's $100. End of the story. That's why you decrease the prices. Okay?
So, any other questions? Good.
Thank you.
Thank you very much, Mr. Erosa, for your presentation. Ladies and gentlemen, with the claims, it comes in my mind like, let me share a little joke to keep the atmosphere warm again here. We people, I'm seeing like, with this heavy meal, sometimes we go more technical and start dosing ourselves. So I have to keep you awake. Mr. Smith was brought to the hospital and taken quickly in for surgery. The operation went well, and as the old man regained consciousness, he was reassured by a sister of the hospital who was waiting by his bed. Mr. Smith, you are going to be just fine, said the nun, gently patting his hand. We do need to know, however, you intend to pay for your stay here. Are you covered by insurance, sir? No, I am not. The man whispered hoarsely. Then can you pay in cash, sir? Persisted the nun. I'm afraid I cannot, sister. Well, sir, do you have any close relative? The nun questioned sternly. just my sister in New Mexico. But she's a humble spinster nun. Oh, I must correct you, Mr. Smith. Nuns are not spinsters. They are married to God. Wonderful, said Mr. Smith. In that case, please send the bill to my brother-in-law. So, ladies and gentlemen, when it comes to claims, we always say, when we go to underwrite, then we relish and enjoy writing risk. But when it comes to real claims, we always see that we had to swallow bitter pills. And then this is where you have to keep the balance with the client and then with the underwriters as well. And this is the role of brokers, which we do here. So my next panelist, let me introduce him. And I kept this particular panelist for my last session, and I have moved a little bit. The reason is that I know today ERM is the key word which is everywhere. If you go to corporates, everyone is talking about ERM. And everyone is talking about implementation of ERM. And that's what today, when I was introduced by Mr. Kevin Willis, he represents Standard & Poor's as a Director of Financial Institutions Rating Services. I was telling him, he said not necessarily, that's a keyword everyone wants to stay and talk about, but really are we practicing and are we doing more than that? Let me give a little bit of a briefing about him. Sorry, I have to, yes. So Kevin is a Director of Standard & Poor's Financial Services Ratings and a Chartered Certified Accountant. He has worked at a Standard & Poor's for over 16 years and is sector specialist for Middle East and African insurance rating, coordinating a growing team of analysts and assignment in these regions. Kevin has worked on the development of Standard & Poor's rating criteria for the Islamic insurance, the Kaful market, and was also heavily involved in developing and applying Standard & Poor's credit analysis to the Lloyd's syndicate insurance market and the European credit insurance market as well. Kevin regularly produces articles and speaks at conferences. This is one of that, concerning the rapidly developing Middle Eastern insurance market. And Kevin has recently relocated to Standard & Poor's Dubai office at the DIFC and is looking forward to developing the company's already strong relationship in the GCC insurance sector. Kevin was previously financial controller for the International Minute Group of Insurance Brokers, where he worked for over 12 years, and finance director on an executive search consultancy, qualifications fellow of Association of Chartered Certified Accountants, postgraduate diploma in business administration, so you know the man is filled with academic knowledge and experience as well. So let's give a warm welcome to Kevin here, ladies and gentlemen. Here is a dash for you, Kevin.
Thank you. Thank you, Aftab. Good afternoon, ladies and gentlemen. There's been a common thread running through the presentations today, and they've all been fascinating, but risk management is clearly somewhere in all of them. I'm reminded that Aftab this morning spoke about the marine and energy sector. Some of the slides he used were a graphic demonstration of the cyclicality of the insurance industry and the risks of too much capacity, capital, if you want to use an alternative word, chasing volumes of business and driving prices down, and the slow but always expected correction mechanism that comes through the insurance cycle. Mr. Youssef Kanenda of the IFC spoke eloquently about the need for risk management through the project finance initiatives that they introduce. And I think the common thread that runs through these not only is risk management, but the fact that risk management covers a period of time that needs to deliver results. And we as a rating agency want to see that those results are being maintained. Mr. Murat spoke about claims management. a clear aspect of risk management processes. So let's move forward to my presentation. I'm sure you're all familiar with this scale in some way. It is a list of the different ratings that we have within Standard & Poor's that we assign to any entity, be it a bank, an insurer, a sovereign state, a cement company, to demonstrate the financial strength or the claim or the credit strength of the entities. At the bottom in the yellow we have the vulnerable rating scale, and in the blue at the top the secure range. A thought that was going through my mind when I was looking at this earlier today is, well, why is it a pyramid? We don't have more companies down in the CCC range than we do at the single A range, but we certainly do have fewer at the AAA rated level today than we did this time last week when I was trying to formulate these slides. But what I want to emphasize with this slide is that the ratings we present are forward-looking. We look at the history of an entity. How has it reached the point it is at today? What are the management skills the company is introducing to that entity to control the development along the lines that they want to reach? And part of that is clearly the risk management profile that they are willing to accept. Companies make profits by taking risks. They make losses by taking uncontrolled risks or unrecognized risks. So the ratings management framework, the enterprise risk management framework that Standard & Poor's is talking about, is a forward-looking perspective on demonstrating control and delivery of results to an organization. So, for an insurance company, we assign a financial strength rating. A financial strength rating is a current opinion of the ability of an insurer to meet its obligations to policyholders. It is forward-looking. Very important point. It is not a recommendation of investment or guarantee. It's not an absolute measure of default probability. And it's not an audit of the issuer. The point I pick out here in that bottom section, absolute measure of default probability. We look at the previous scale, the rating scale. Today, we would look at the historical default record of entities going down through that scale. At the AAA range, the AAA rated entity has something like a 99.9% survivability record over a 15-year history. At the single A level, I think it's 99.5%. And at the double B level, it's round about 96%. The statistics are not correct because I didn't bother writing them down, and they've not sunk in my mind. But we are looking at long-term survival of companies through all types of economic and operational cycles. So, who uses insurance ratings? You're as familiar with this as I am. Investors use them. Intermediaries use them. Issuers use them, business financial institutions use them. And once again, the common characteristic here is that they are looking forwards. An investor wants to put in $100 million and make sure they get a percentage return within certain parameters. The intermediary wants to place the risks they are handling for their clients with companies that they know will pay the claims at some indeterminate time in the future. If it's a motor risk, it could be 6 weeks' time. If it's an oil production risk or a liability risk in the London market, it could be 6 years, 60 years even, if we look back at history in the marketplace. So what is going to happen is important.